If you are in your 20s, staring down a mountain of debt, you are likely worried about a market crash in 2026. Headlines about sticky inflation and an AI bubble make it feel like the financial sky is actually falling. While the news focuses on a potential crash, the measurable danger for young investors is the cost of sitting on the sidelines while their money loses value to inflation. Welcome to Minted Mosaics. We break down the complicated world of money so you can build your wealth piece by piece. Today, we are going to look at the data behind the current economy and lay out a 5-step actionable plan to protect your money and find opportunities, regardless of what the market does. Before we go any further, hit pause. Gather your current credit card statements and a list of your monthly expenses. We are going to build your exact strategy right now, using your real numbers. Turning those numbers into a plan replaces uncertainty with a checklist. You are no longer reacting to headlines. You are following a mathematical blueprint designed for long-term growth. Step 1 is understanding the inflation treadmill. This diagram shows a pile of cash on one side and a rising inflation rate line on the other. Notice how the cash visibly shrinks against that rising line. Keeping your money strictly in cash guarantees a loss of your purchasing power every single year. To slow that inflation line down, the government pulls a lever. They raise interest rates. Because inflation has remained stubborn, expected rate cuts are being delayed. This causes the stock market to fluctuate by about 5% as investors adjust. That movement is normal. It is not an indicator of a total collapse. Step 2 is navigating the artificial intelligence sector. With tech stocks at these high valuations, many beginners fear a bubble that will wipe out their savings. Think back to the gold rush. The few people struck it rich finding gold, but the people who consistently made money were the ones selling the shovels. In the AI market, certain companies provide the foundational infrastructure, the microchips and the data centers. Investing in these shovels is often more stable than betting on a single, unproven software company. When you understand inflation and the role of infrastructure, you see that market fluctuations are standard operating conditions. They are a part of the process, not a reason to leave the market. Step 3 is a defensive move, digging the moat. Before you invest in stocks, you need an emergency fund covering 3 to 6 months of basic living expenses. This moat prevents you from being forced to sell your investments at a loss if you experience a sudden job loss. You should store that fund in a high-yield savings account. This interface shows the goal. Your money remains fully accessible for emergencies, but it still grows at a rate like 4.5%, which helps it keep pace with inflation. Step 4 is slaying the dragon. High-interest consumer debt, particularly on credit cards, is the primary barrier to building significant wealth. This chart compares an average 8 to 10% stock market return against a typical 25% credit card interest rate. The mathematical reality is that paying off that credit card gives you a guaranteed 25% return on your money, something no stock can promise. Prioritizing your cash moat and eliminating toxic debt creates a layer of security. This foundation protects your daily life, even if the broader market experiences a significant dip. Step 5 is your investment strategy. Buying the supermarket. Trying to pick the one winning stock is a gamble most people lose. If you walk into a grocery store, you do not bet your savings on one brand of cereal. You buy a tiny piece of the entire store. You do this through an S&P 500 index fund. Hitting buy on this fund means you own a fraction of America's 500 largest companies, which spreads your risk across the entire economy. This requires a shift in how you view the market. Most people run away when prices drop. But for a long-term investor, a price drop is effectively a sale. This chart tracks the S&P 500 through a 20% dip. In your 20s, you are in the wealth accumulation phase. A 20% drop means every dollar you invest is now acquiring 20% more shares of those 500 major companies. Investors who lose money are typically those who panic and sell during the dip. Those who build wealth are the ones who automate their investments and continue buying regardless of the current price. Through a diversified index fund, a 2026 market correction becomes a window where your monthly investment buys a larger piece of the American economy for the exact same price you paid yesterday. By following these steps, you have built a fortress. You understand inflation, you are focused on infrastructure, you have a cash moat, you are targeting your debt, and buying the whole supermarket. Trying to time a market crash is a guess. Consistent, automated preparation is a strategy. To start step 4 and eliminate your credit card debt, click the video on your screen right now. We break down the exact debt payoff strategy for beginners. Taking these steps today ensures you are building a financial masterpiece, regardless of what the 2026 headlines say. Keep building, and I will see you in the next